Hey, folks. Dan Frio here. Sorry about that. We had a little bit of glitch in there for a second, but I hope you can hear me. Give me a thumbs up, everybody, if you can give me, if you can hear me right now, because we want to go over to what's happening in the markets as we speak. So the federal chairman's going to speak here in a second. Let's get over to this and see if he's out there yet. We're going to follow this right through here. But here's what we're seeing behind the scenes right now. And folks, if you could, please give me a thumbs up if you can hear me. Give me a thumbs down if you can't. Just give me some feedback. I need to know if I'm out there, folks. Okay, so here's what's going on in the background right now. Federal Reserve came out and they said they are going to do nothing, absolutely nothing with rates right now. But there was some verbiage that they put out, and it actually is what's shaking the markets right now. So the verbiage is this. Let's get over to it. Here's one piece of information that we have so far, and I'm going to go through this until the Federal Reserve chairman comes out. So let's get over to some things. And here's something that you guys might not have realized. And these are things I know behind the scenes that you guys need to know. Okay, so here's what, when the Federal Reserve comes out each meeting, what they do is they come down through here and they give us basically in writing or just in text, what their statement is. And every time, and it's basically exactly the same thing. So here's what we're seeing right through here. The changes that they provide us are in red. Okay, so here's one of the things that they said is uncertain, the has increased. So basically the economic outlook has increased. Basically the uncertainty increased. Here's what I want you guys to look at down through here. Here's how much bonds the Federal Reserve has been selling. Okay, so why is this all important? Well, it's really important because here's what happens is, we follow the bond market every day. What's going on? Okay, if the prices go up here, we're seeing a nice rally right now in the MBSs. So mortgage rates should be coming down just a little bit. But right here, here's what we're seeing in the bond market. But here's what I want you to understand is how much debt is out there. Okay, so there's a ton of debt out there that we have, and that's right through here. And what happens is what the federal government has to do is they have to sell this debt and get it sold. And the Federal Reserve buys a lot of the debt. Okay, so they bought a lot of mortgage-backed securities over COVID as well. So basically, here's what happened. When you start hearing quantitative tightening and quantitative easing, this is where it comes into play. Okay, so when the economy is doing really bad, like we had during COVID, what happened was the Federal Reserve, they stepped in and they started buying up mortgage bonds, bringing down the rates. That's how we got rates at like 2.5% to 3%. And then they also started buying government bonds because the government was just pumping a bunch of money out there. Okay, so they were buying billions of it a month. Okay, so what's happened though is during, after COVID, when the rates started going crazy and and inflation started going up and everything, what the Fed did is they wanted to reduce their balance sheet. Okay, that's quantitative tightening. So when the Federal Reserve is buying debt, and mortgage bonds and everything, they're helping the markets basically take all this off the market, driving up the prices because they're out there buying. They're driving up the prices and they're driving down yields. Okay, that's when there's not enough bonds out there. What's happened though is there was way too many bonds out there. So on top of that, the Federal Reserve was selling on top of this massive amount of treasuries that was out there. Right through here. Beginning in April, the committee will slow the pace of decline in its security holdings by reducing the monthly redemption cap of Treasury securities from $25 billion to $5 billion. That means they're going to stop selling as much debt in the market. So we have the government just pumping out all this debt, and then we have the Federal Reserve pumping out the same amount of debt that they bought in the past. So you have tons of bonds hitting the market. What happens when that? Like we know what happened in 2008. You have way too much of something, and what's going to happen? Prices are going to deteriorate. Well, that's exactly what happened here. So when the prices deteriorate, rates go up. So now with the Federal Reserve coming in and saying they're going to reduce the amount of bonds that they're selling, that's fantastic news. So this should help stabilize the bond market quite a bit. And this is why the 10-year Treasury, we watch it. It's not the determining factor of, it's going to make, create interest rates or mortgage rates because those are tied to the mortgage-backed security bond right through here. So we're seeing a nice rally in MBSs right now based on this news. So the other piece of this puzzle that we want to see, and I haven't found it yet, is the dot plot. And I don't think it'll be out just yet. They might show us during this conference that they're going to have. We're waiting to go live right through here. But I want to see the dot plot coming in. So what the dot plot is basically, let's go over to here just while we're waiting for the Federal Reserve to come out. Let's see, this CME Fed Watch tool. Let's see. We're going to go to the CME Fed Watch tool now. The Fed's not meeting now till another 48 days. But let's see and go and see if they updated their dot plot. So what the dot plot it actually tells us is what each member of the Federal Reserve is expecting rates to go over the next year, 2 years, 3 years. All I'm concerned about is the next couple months. So let's see. They have not updated this just yet. So basically, what this is telling us that every time or 4 times a year when the Federal Reserve meets, what happens is certain members put a dot where they expect the rates to be. So this is the federal funds rate, the rate that the Federal Reserve controls. Right now, it's 4.25 to 4.5. It's right in this range right through here, right where the blue dots are. Okay, so right through there. The last reading on this was in December. There was only one person that thought rates would stay this high this long. Everybody else had rates coming down to here. This is 3.75 to 4. Okay, so that's what we want to see how they refresh this, and do they move more up and down, and where does the consensus actually put us in there? So that's the news we got there. Hey, if you guys would please let me know where you're watching from. What we're waiting on right now is the Federal Reserve chairman to start talking. Here, let's see if we can go. Oh, he just finished his speech. Now's the question time. So now we're going to see market reactions. Okay, well, I'll cut to the chase. I don't know why there's no audio out there, folks. My apologies. I don't have my counterpart in the background helping me today, so my apologies on that. Let me just go through what he's going to say, and as I talk, you're going to see the markets react right here. I know most of this stuff because I've read the transcripts and the other things. Basically, the bottom line is this: the Federal Reserve doesn't really know what's going to happen, and that's what they basically talk about. They're pounding him on tariffs and inflation and immigration and wars and everything else. But here's what's going to happen. Here's what you're going to see. The biggest piece of the puzzle that we got today was the Federal Reserve. They're starting to reduce the amount of bonds that they're selling. That's going to help the markets tremendously. You gotta trust me on this one, folks. The other piece of this equation is we want to see their dot plot, because everything I was reading so far still has even the Federal Reserve members expecting 2 rate cuts in the rest of this year. So that's what we're focusing in on. So what he's being questioned right now is on tariffs and different things like this. Let me try one other way of doing this, and I'm not sure if it's going to work. Let me go to YouTube and see if we can pull down the stream from there. Usually I do this on my videos every day, and you can hear. Okay, so can you hear now? Sounds fishy. Sounds fishy, bro. Let's see if we can find the Federal Reserve in here. Let me know when this pops up if you guys can hear the audio. Can you guys hear that? Can you guys hear the audio at this time? Okay, my apologies, folks. Okay, so what we're gonna get is he was talking about tariffs. Basically, says they're on a hold mission right now to figure out how that goes. But he basically was saying, I'll pull up the screen right now. This is the data that they watch. I'm sorry, I got to pull up one other the financials at a glance. So when you break these down, here's exactly what he's saying. He's saying, well, inflation on the PCE, it's coming down. Actually, the last or 2 weeks ago, the PCE dropped about 30 basis points. Um, that's great news for that. The tariff piece of this is the part that's really throwing the unknown on here. And then with Doge out there slashing jobs and cutting this and cutting that, it's just like there's a dust cloud in the air. And even the Fed is coming out today, and this is what they're saying, is they don't really know what the projections are going to be. They're like, everything that we're seeing right now, we have the inflation numbers coming down. The last reading, it did come down. We have the job market that's still stable. We have income that's outpacing inflation. We have GDP. Their next reading, they're saying it's going to go from a 2.3 to 1.7. It's still a positive there, and they even admitted they're saying we're restricted right now, but we don't know what's going to go on with the tariffs and the immigration situations. So that's what we're seeing on this side as well. So, folks, my apologies. I launched PBS. So if you guys, if you're watching that video, here's the take I want you guys to get out of today's context from the Federal Reserve. Okay, they came out, they changed their verbiage. What I want you guys to see, though, is as this verbiage comes in, what's the market's doing? Market just jumped, okay, based on this news. Sorry, we were focusing in on interest rates. The markets are loving this. The VIX, look at the VIX. It's down 7%. This is the anxiety level on Wall Street. So all of a sudden, this is kind of a relief because the Federal Reserve did come out today and said, we still expect 2 rate cuts. This year. So that is now the markets are saying, okay, we at least have an idea what's going on. So that's what's going on behind the scenes. And then they're going to ask them about the tariffs. And that's the biggest unknown and the biggest question everybody has is what's going on with tariffs? What's going on with tariffs? But the biggest news is, again, the takeaway from this is we'll come back tomorrow, unless it's loaded up by the closing bell today, is I want to go over the dot plot because the Fed chairman came out and he said, we're expecting, and he rambled about it, but he said 2 rate cuts. Okay, so but what I want to see is the dot plot. It's going to come out and tell us exactly where each member puts a dot on where they expect the federal funds rate. What you have to understand, though, is when they come out with these calculations, they're focusing in on here. Let me find it right there. The federal funds rate. Okay, when they talk interest rates, when they talk 4.25% and 4.5%, don't think this is your mortgage rate. This is actually the federal funds rate. This is an interest rate that interbank lenders charge each other. Like if a bank needs money at the end of the day because they're not solvent, they can go to this and transact between different banks and get money to be solvent by the end of the day. But I am so sorry about the audio stream. But right now we have the MBS is up 19, which is fantastic. We can close this down because the audio is not working for some reason on that situation. But the Fed held steady at 4.5. The good news behind it is they're going to reduce the amount of bonds that they are selling. And that's going to help the bond market tremendously. If you guys have any questions, please ask them. I apologize about the audio, but I'm here to answer any questions on how you think this might change short-term, long-term, mid-term goals. What's the next thing to drop that we should be paying attention to? These are all the questions I'd love to be able to answer for you. Hey, love to see you. I haven't heard from you in the last day or two. So if you need some help with some things, please shoot me an email. Let's get to some questions you guys have. Are there certain times of the day when I should be looking at the markets? Absolutely not really. It's what I try to do is I try to give you in my morning update things to look toward. And what I usually do a lot of times, most of that data is coming out before the market opens. Like for example, on in the equity markets, what happens a lot of times is you'll have earnings reports like after the bell. So let's say, for example, today the market closes, and then some ABC company comes out with their earnings report, 5, 6 o'clock tonight. Well, it might be great news, but the market's not opening till tomorrow morning. So what happens is a lot of times all that data is digested before the market's open. So on my opening bell, what I try to do is give you the on Sundays or Saturdays, I try to come out with new videos, and I just started that a couple weeks ago to give you what the calendar looks like for the week, the economic calendar. And I always point out the main things that will be affecting the markets. And when I talk about the markets, I usually try to combine the two equities, what I think the equity markets are going to do, like stocks, and then also what the bond market's going to do, because sometimes, or most of the times, it should have a kind of a yin yang effect. Like if normal in history, and you can go back and check this, when you have a big sell off in stocks, like there's a war or a famine or whatever, people just get out of the stock market. They just dump. All you hear is they're fleeing to safety. So they're just buying bonds and putting their money in the CDs and things like that. So usually what you see is you see the stock market crash, and you're like, oh, this is good news for bonds because people are moving their money over to bonds, thus bringing down rates. Well, since COVID and everything else, the markets are so kind of upside down that those old things don't really work anymore. But they're starting to come back. The normalcy in the economy is starting to really kind of look cool. People's savings rates are getting back to normal. Income levels are a tick or two above inflation numbers, and that's what we're really focusing in on. But great question. There is no particular time of day. It's when the news comes out and what news is coming out and how that is going to affect the markets. So any other questions that you guys have up here? If not, I will conclude now. I just wanted to see you. Let's see what the markets are doing right now. Up 350 points, a nice little rally. Watch speak on rates and economy impact on tariffs. So watch this video tonight on your own, but here's what happened. I just love you guys seeing this. It's a nice little rally. Now, will this last? I don't know. So if you're in the mortgage companies might not react to this real quick. You're going to see one company came out and reduced their rates a little bit. I think most banks are going to just sit on pause right now, see how the after effect of this is, because it's almost 2:00. The markets are almost closed. So you're going to see some balancing tomorrow morning. What that's going to look like, I'll be back at the morning video for that. But I will be back later this afternoon with the closing bell to let you know how this finishes, how many mortgage companies actually reduced their rates or adjusted rates, and then getting back to the equity markets, they're hovering at nice levels right through here. Everything is up at least 1% or more across the board. VIX is down. Let's see what the heck's going on with cryptocurrencies. Is it 84? It was 106 about a month ago. So that's taking it on the chin. And one last thing, oil. Oil is up, but it's still below $70 a barrel. So that helps huge when it comes to the inflation number. So if you don't have any other questions, do you think, here, let's go down, but please start loading up questions, folks. That's why I'm here. Let's get to the next one. And I know I should be buying stocks soon, but I get it because I have no clue what I'm doing. Any videos you can point me to. I was trying to do what they call stock talk, and I was doing it on Tuesdays. We're really busy. We're probably taking 5-7 applications a day, and we're not a huge organization, so for us that's a big number. But here's my point. I would go with like Berkshire Hathaway. I'm not an investor, counselor, advisor, whatever. Just look at some things that are just stable, like the S&P 500 ETF index. Just Google it, or just do a DeepSeek or ChatGPT and just type in the words. You want to invest in the S&P 500. You want an ETF with the highest yields and the lowest costs. And you'll be amazed on what the results are. And that's what I do a lot of times. And I was trying to do it last week. I think I made a video. No, I didn't make it Sunday. I'll be making a video on how I just check my videos up there. I made a video on how I just use DeepSeek and Chat GPT to do all the analyzing for me for stocks. And it's amazing on things that you can find, and it finds for you. So great question. Next question we got is 27, 30 seconds in 10-year is at 4.25. What's the 200-day moving average? 418. Okay. I'm 200-day moving average on the 10-year, 418. I think it's more to close to 4.3. I'll look into that, and I'll put it on today's closing bell video. Do you think rates will come down starting in April? Well, they're going to probably come down a little bit right now based on what the MBS market's doing. So here's how to understand this, folks. So if you're kind of new to the channel, what we focus in on here every day is basically, here's what I do. I come on and I tell you what the news of the day is going to be. I'll go across the board on the economic calendar, and then we'll start piecing it together. But what we do is we focus in on this chart right through here that you're seeing on the screen. Why? Well, I'm actually a mortgage advisor. If you don't know, my name is Dan Frio. I work at a federal bank. Our slogan, it's pretty cool. It's one application, one credit pool. We're going to shop your loan to over 30 different lenders. Now, how do we do that? I'll talk about that here in a minute. But here's basically the bond that creates your mortgage rate. Okay, so the yield on this bond is the biggest component of your mortgage rate because it's a mortgage bond. Right up through here, it says MBS. Okay, so I'll explain to you how this works. When a bond price goes up, rates come down. It's kind of vice versa the other way. Kind of like, when the government's buying all these bonds, they're just buying and buying and buying, taking this. Here, I'll make an example for you. So here's how this works. Let's say up here, the maturity value of this bond, we're going to say is $100. Okay, just to make it simple. Now, some of you guys might have heard this story several times. It might be the first time for you. But this is how all bonds work and how yields work. Okay, so let's say, for example, this bond, it's $100 face value. And I'm going to show you how if I pay you a higher price, how the rate comes down. Okay, so let's say, for example, the bond's $100 maturity value. Today, I'm going to give you $50. That's what that's what I have to pay you today. It's a low price. So I give you $50 today. You give me the bond, the mortgage bond. I hold that bond till its maturity. Let's say maturity comes. I give you the bond. You give me $100 back because that's the maturity or coupon value of that bond. Okay, so I gave you $50 and my investment gave me back $100. What was my yield? How much did it? I doubled my money. Is 100% yield. Okay, so now let's drive up that price. Like, let's say we bought it $50 down. Now let's drive up that price so I can show you how rates come down. Okay, so here's that. Let's say, for example, this bond's a $100 face value bond. I give you $100 and you give me the bond. Okay, you might be catching on so far, but time goes on and the bond matures and I give you the bond back and you give me my $100 back. Well, what was my return now? Zero. Because I gave you 100, you gave me 100 back. So do you see how if the price goes up, the yields come down? We love this chart because this means mortgage rates are coming down. Okay, so will this last? Well, last time, if you go back to about 6 months ago in September, right through here, we got to go a little bit farther. Right through here, this should be September. This is basically where we were, and this is where rates were really high. And well, coming into that, here's where we were. So rates are coming down, down, down. Okay, remember this is going up, rates are coming down. So I said it wrong there a second ago. Then the Federal Reserve cut on September, I think it was 17th, 16th, 15th, right here. They cut. Everybody's like, this is what people were waiting for. They're like, okay, I'm waiting for that rate cut from the Federal Reserve, and now I can buy a house or now I can refinance. What happened? Remember, down is bad, and they just crashed. Okay, this is when September, when the Federal Reserve cut 50 basis points, the first time they cut, and they just mortgage rates skyrocketed. So are we in for a fake again? Like it went up here and then came down, went up here, came down. So this is giving more and more people opportunities. If you're looking to buy that first house, you might have a little window here. How long these are going to last, I don't know. Let's just get over to where mortgage rates are for today. Let's pull that up. And mortgage rates, this is saying it's up 2 ticks, so it hasn't been refreshed. And again, folks, you might not see a lot of banks actually doing anything until tomorrow morning when the market's open. Because if I'm a bank pricing loans right now, I'm like, okay, we close in what, an hour or two? Let's just hold on for now, and we'll readjust our books tomorrow. So you might not really see a big deviation in rates today, but right through here, here's where here's what you're looking at. But for today, nice little rally going on right through here. So again, going back to the what the indices are doing right now, we got the stock market. Dow gains now 400 points. Let's see if it's over 400 now. Remember, it was 350. Now it's 450. So you can see the markets are rallying. Now everything is up at least 1%. You have mortgage bonds still rolling. So great news. The Fed must have said something maybe that I missed. But any other questions, please ask them. Let's see what we got next. Did I answer this one? Let's see. I think I answered that one. Yes, I did. And then this one, let's go. ETF index, highest yield and lowest price. No. Lowest expenses. So do ETF, highest yields. You want an S&P ETF, highest yields, lowest expense factor. That should do it for you. Berkshire Hathaway, you put in there Brooks Hathaway. There's a Berkshire Hathaway, BRKB. It's a B share. Great yields on that thing too, and their returns on their investments are fantastic. But the S&P over the last 2 years has gained over 25% per year. So a lot of people are like, I can't make any money. The returns are there. You got to do your due diligence. Sometimes you got to take some risk. Like a lot of people that I talked to. A couple people, I actually talked to 2 people yesterday, and they were kind of ticked off. They're like, I'm so sick and tired of watching. And they mentioned Nick, Reventure Consultants or whatever, the crash doomer guy. He's like, I'm so sick and tired of watching these guys' videos. I'm in Tampa. I've been waiting since 2021 to kind of waiting for that crash. He said prices now are up 100, 200 grand from where they are. I could have got a rate at 3.5. Now rates are 6.5. And so he was so disgusted. So that's why I'll be putting out a home crashing video on Saturday. Hopefully you guys can watch it and make some sense of things. But that's also another area, you have to focus in on. If you're looking to buy stocks, just like F asked, you got to do the same due diligence if you're looking to buy a house. Don't just watch me and think I know everything. I don't know where you live. I don't know what your market's doing. When it comes to mortgages, financing, I'd love to help. So let me conclude the video by this. My name is Dan Frio. I do these videos actually 2-3 times a day to help you guys understand the mortgages and homes and real estate and even equity markets and how all this is tied together. So if you need some help, if you're looking to maybe buy that first house, maybe buy that first investment property, or looking to refinance, we got a lot of people in high 7s and low 8s right now. They're missing an opportunity. Don't let it slip by, because this might be another opportunity for you to have, because how long this is going to last, I don't know. We just need some piece of bad news to hit, and we can be all the way in negative territory once again. So again, you can go to therateupdate.com. Our slogan is one application, one credit pool. We're going to shop your loan over 30 lenders. Now, how in the world would we do this? I'm actually a mortgage loan officer at a federal bank. We're licensed all throughout the country, as well as Puerto Rico. I'd love to help you. The cool thing about us is we also are associated with 32 other lenders right now. So the nice thing is you can go to this website, therateupdate.com. You can put in your application right through here. You can schedule a consultation, or you can even scroll down below and give us a call right down through here. And if you do, we can help you. We're actually a mortgage lender and a mortgage broker. So I can help you anywhere in the whole country, as well as Puerto Rico, if you're looking to buy, refinance, or even invest. So that's what we're looking to do. If you need some help with that, I would love to help you. God bless, folks. Thanks for watching. Thanks for being here. My apologies about the audio, but I'll be back later today. And in my closing bell, I'll have some clippets of the main areas of the Federal Reserve's comments that I think you should hear. And those would be the main points on why the market's doing what the market's doing. Thanks so much, folks. Can't wait to see you next.